Hello. What happens when you backtest 59 million candles 200 times for the floating grid technique? That's exactly what I'm going to answer today in this video. A viewer named Sam asked that question regarding my floating grid technique. What happens if we backtest it longer and show a larger history than just the 1 year that I have been using in my own live trading account? The results are quite interesting and changing in the terms of my thinking process and my own trading perceptions. One of the major changes I've already made is I've changed the deviation of my grid bot. I was using smaller amounts, but I've chosen to move up to 30 pips for the time being. The results of these tests are really shocking in terms of what I didn't expect I would see based upon the long-term analysis. In many ways, it answered a large number of questions, but it asked just as many as it answered. One of the immediate impacts of changing the strategy is that it had a direct difference in the profitability. I went from roughly an average of 10 cents per trade to an average of 50 to 55 cents per trade. Now, trading is, of course, slower because the pips need to be more in line with the actual steps I'm taking. The interesting part is for the market that I'm trading, which is a $1,350 market. There are 150 units as my starting point and 73 levels. That works out perfectly to fit that specific trade level. Of course, now questions are, what happens if I have more of a budget to work with? And what happens if I blow up the account? Considering my margin is only about 625. So if the account goes over 625, it gets liquidated. So that is a significant factor when we look at the results. But overall, you are going to see some very interesting results. So let's get straight to the table and really get into the numbers. Okay, here we are in the spreadsheets, and I have two of them. I have colored them based upon profits versus losses, and I have separated them from the floating grid without reductions versus the floating grid with reductions. And what we are looking at is a range of take profits from 5 pips to 50 pips, and within that, a range of deviations from 5 pips to 50 pips. So a total for this table, which is reductions, of 100 trades. And we can see right away, anything above $625 is a blown account when testing the entire lifespan of all 59,472,710 candles. So let's look at this table in detail and really highlight just how critical this test really was in changing my own thinking about long-term processes with the floating grid technique. Now, the short term is amazing, which I've demonstrated multiple times. But as we can see, for the very first line, if you're using a 5 pip take profit and a 5 pip deviation, you're going to blow your account up if you follow 73 levels. Now, all of these tests stay with the 73 level, 1350 deviation, 1350 budget with a 625 margin limit. And we can see quite a few accounts get blown into oblivion. We have to be under 625 to keep the account. And we actually end up blowing up 53 accounts of different take profits and deviations, which is quite interesting. There are very few accounts that actually survive. So we end up losing more than half of the accounts. But now, in looking at the trades, all of these accounts are in loss. So basically, 64 accounts lose money of different relationships. We don't actually start making a profit until we have a take profit of 20 pips and a deviation or a stepping of 30 pips. Now I chose for this test an average of 2 pips for my spread. In observing the market, sometimes I would see 1.1, 1.3, all the way up to 2.7 pips for a spread. So I figured a rough estimate of 2 pips would be good enough for this analysis. And we could really see 64 trading combinations failed. They lost money throughout the entirety of the 59 million candles. And this is with the reduction technique. So that is really surprising that the reduction technique failed so harshly. And we see the amounts of the reductions along with the stop losses and the profits. So on the very first one, even though it lost $12,000, it did $5,000 in reductions. And the total P&L does not count the reductions. So if I was to count the reductions on this account, it would be a $17,000 loss. That is actually surprising that it would have lost so much with reductions. So let's go down to where the profits begin and actually take a look as we keep track of these columns. So in looking at the profits, we can see that the account does not turn profitable until we start with a 20 pip take profit. But even then, if we look above, we can see the deviations as well and how well they work out. So a 20 pip take profit, a 30 pip deviation leads to a miserable $2 profit for 19 years of trading. And we have a reduction rate of $1,900. That is staggeringly disproportionate to what I really expected. I figured reduction would do better in the long run. So now with this information, I really have to start rethinking my strategy. So let's continue into the profitability. And we can see different levels of profitability and what to expect out of them. Now remember that this does not take into account compounding. Compounding would make the losses worse and the profits better. But it's good enough to really begin to think about the consequences of our trading and just how well that works out. And I am by no means done making changes to my own account just because of what I've learned here. So here we have the 30 pip take profit, 30 pip deviation. And it shows a $445 profit with a $1,408 reduction. It's profitable, but it's nowhere near what I expected. This is actually surprising. So I still have more work to do on my account to to bring it up to a better standard. And the questions that come to mind right away is, does this hold true with different assets? And I'm going to have to run more tests to find that out. But if I go to the best, the highest profit of all, with reduction, we have a 50 pip take profit with a 40 pip deviation. And this is really, as we look at the different results, the point of reference necessary for getting the total profit and loss above the reduction level. This is amazing of the drasticness that the reduction has with the total profit. It's actually staggering. And we can see even with the reductions, the level of stop loss is involved. So now, let's actually take a look at this very same table without reductions. That is, we're going to see what we have without reductions. So this column is going to disappear. And here we see the table with no reductions. And we can see a jaw-dropping, staggering 4,500 stop losses with a 5 pip deviation, 5 pip take profit. Now, if you compare that, it's not that different. And that's even just as much surprising when you're looking between the reductions versus the non-reductions. 500 take profits, 500 stop losses, but you still have 4,069 stop losses even with the reductions, and a staggering $5,000 involved in reductions. But we have $12,636 in losses with the reductions. Without the reductions, we have $12,677 in losses. There's not that much of a difference. The long-term implications of reduction did not reduce the losses that much. That is just surprising. None of the real trading data that I have seen with my own real money suggests this level of closeness. So let's continue. Let's see how many accounts would be blown up. We already know roughly 64 accounts would end up in a margin call at the $625 level. So here, without reductions, only 43 accounts end up being liquidated. Another surprise. So let's see when it actually becomes profitable. So it becomes profitable basically at the midpoint, roughly 50 accounts. And even then, the profits are significantly better. The first profitable account is $28 without reduction. With reduction, the first profitable account was only $2. This is a staggering difference. And as we can see, the take profit and deviation has an interesting variance. 45 pip take profit, 25 pip deviation. So let's keep going and see what the most profitable is going to be. And then we're going to go back to the reductions and line them up so we get the same information on the screen. Okay, so there we have it. $1,472. Now, this is with a $1,350 budget, $625 margin limit. So I've literally made double my margin limit without reduction, with a 50 pip take profit, 40 pip deviation. So going back to this chart, and we will go through all the way to the bottom. And here we have a 50 pip take profit, a 40 pip deviation, and we only made $938 with reductions. So here we have a side-by-side correlation where the take profit and deviation ended up to being the same for the highest level, and yet the profit level is staggeringly different. Another surprise to the entirety of this whole process. And looking at the stop losses without reduction is 68. The stop losses with reduction and giving up $804 is only 64. So we only saved 4 stop losses, but we gave up $800 in the process of those 4 stop losses. The irony of it is the stop loss itself would have only been about $20 a hit. So those 4 stop losses would have equaled about $80 versus 10 times that for the reduction process. This is really surprising. I did not expect to actually have this much of a drastic difference between reduction and non-reduction. Now, does that imply that reduction is a bad strategy? Not for short-term trading. Short-term trading in an incredibly choppy market, reduction has a place. But long-term trading, it definitely has some repercussions that really need to be examined. And that is really an incredible surprise throughout the entire process. So at 59 million candles, 200 backtests, I can safely say, thanks to Sam's question, that the floating grid strategy does work very well, and it can survive a long-term thinking process if properly configured. Now, the beautiful part about the floating grid is you can reconfigure it anytime. But you do need to think about your duration that you want to be in the market. If you want to be in the market constantly, year over year, then you need to look at larger take profits, deviations, potentially without reduction. If you're looking for maybe a year or 2 years, basically a very short-term window to capture a bullish market or a bearish market scenario, then reduction and short-term smaller take profit deviations can work well. And as we've seen from the Brainstorm account that uses 250 levels, that's a whole different context simply based upon your levels. So these tests are going to have to be repeated for each and every level that you want to trade. This particular one is for 73 levels, specific to a very particular kind of budget. So the results here are fascinating, but nowhere near conclusive. Share your thoughts. Let me know what you think about this and how this floating grid strategy will hold up with the principles that you've discovered here. How can you use this information to improve your trading? So, as I said, I've already made changes in my own strategies and thinking processes regarding what I've learned, because I did not expect to see or discover just how drastically different and yet similar the long-term and short-term contexts would actually be. Share your thoughts, leave a comment. If you like this video, please give it a thumbs up. Thank you for watching.